I'm Alan Kenny, and I'm in Dallas for NAREIT's REIT World. I'm joined by Chris Volk, President and CEO of Store Capital Corporation. So Chris, about what, $1 billion in acquisitions so far in 2017? That's a busy year. Should we expect a similar level of activity in 2018?
So our guidance for 2018 has been a net number, and this is also true for 2017. So our net number this year we think will be around $900 million for the year. So we're about $1 billion year to date. So before the fourth quarter happens. But net of sales, it'll be somewhere around $900 million is our guess. We've been on a pace to do roughly $100 million a month for the last 3 years worth of acquisitions. So if we were to do the same pace, you're certainly doing more than $1 billion for next year.
And being here at REIT World, what are some of the more popular kind of topics of conversation that you've been hearing in your interviews or meetings with investors and analysts?
Well, at the very end of the second quarter, we had Berkshire Hathaway take a 10% stake in the company, actually 9.8. So if I had to say what's the most popular discussion is people asking us how did that come about, but I think it's been both gratifying to have an investor like that, but also because obviously it says something about us as a leadership team and us, our company from a business model perspective. But at the same time, it shows that a generalist investor like a Berkshire Hathaway can find REITs to be an interesting place to put their money, and so we were thrilled to do that.
And as a retail company, what's been the biggest surprise for you in 2017?
Well, we're not really a retail company. I mean, the interesting thing about real estate is that people think there are only 4 kinds of real estate. So you have retail, industrial, office, and multifamily, and so that leaves very little imagination. So, so if you think about what we own, most of what we own is service-type assets, and so restaurants or early childhood education and so on. The thing that's surprised us, I guess, the most, and it's been a little bit unfortunate, has been the concern about the broad retail business climate out there, given the fact that there's somewhere around 9,000 plus or minus retail stores closing, and so people have wondered how this affects a company like us. And I think that the big surprise for us is we didn't quite see that level of concern coming because so little of it actually falls off on our business.
You mentioned all that variety in your tenants. What's the biggest traffic driver? What types of stores are your biggest traffic drivers?
Well, I mean, again, we're focusing just really heavily on service businesses, and of course service businesses can't be bought over the internet. So I've tried to get a workout over the internet, it doesn't really work. So you got to you've got fitness clubs, you have early childhood education, you have restaurants, you have movie theaters, veterinary clinics, pet boarding centers, oncology clinics, urgent care. So these are things that we've spent a lot of time with, focusing on really profit center assets, where the assets we own are not just real estate for people, they are the place where they conduct their business, and there's an actual P&L hooked to that. And so the service space has been the big driver for us, retail less so, and then behind that is manufacturing. So we own some manufacturing real estate that makes everything from molded children's toys to microchips.
And do you see those services, kind of continuing to be the drivers going forward in the next few years?
Yeah, because we're very much a service-oriented economy. So the opportunity to be investing in service-centric real estate is enormous.
Well, thank you so much for your time, Chris.
Glad to be here, Alan.
For more real estate news and analysis, be sure to visit NAREIT's website, REIT.com.